Hello and welcome to RJ Sanderson TV, the October edition. We're deep into spring. We're 4 months into this financial year and Roy Sanderson is here as always. Roy, welcome to RJ Sanderson TV.
Thank you, Dave.
October, what does it mean for RJ Sanderson? What's on the agenda this month?
Well, apart from finals being over and we're moving into the spring racing carnival, tax returns are due at the end of October, so that's only if you do your own tax return, and we don't recommend that. If you have done your own tax return last year, make sure you register with an accounting firm, and then you have until middle of May next year.
That's what it means for tax returns. Let's check in and see how the economy is tracking in October as we get into our economic indicators. And a good marker for the state of the nation is GDP growth, Roy, and that's the first indicator on our agenda today. Talk us through this one.
Well, this is the balancing act for the government. We don't want that to go below zero for 2 quarters in a row because that would be a recession. So they're trying to get that just to turn around and not go negative, and that's the balancing act of the interest rates.
As you say, it is a balancing act, and we haven't had a negative quarter for a while, which is good, but we've also had flatlining growth. So it is an area that the government needs to address because in times of good GDP growth, there's prosperity for the nation, there's opportunities for jobs, there's opportunities for trade, etc. So it is a key item, but at the moment the government's priority is ensuring that there is positive GDP growth, albeit small growth. One of the reasons that perhaps there is only marginal growth at the moment is inflation. It's an indicator that we've looked at on many and several occasions. Roy, what are you thinking with this inflation chart?
Yeah, it's at just over 3%, and we know the target's between 2.5 and 3% for the Reserve Bank. So this is obviously the balancing act that the government are playing with it right at the moment.
You can see there that inflation is on a downward trend, albeit maybe with a slight correction there very recently. And one of the reasons why it is on a downward trend is because the interest rate has been lifted on several occasions over the last 2 years. The interest rate currently flatlining at that 4.35%. The Reserve Bank not due to meet in October. A nuance of the system there, Roy, 8 meetings a year. It doesn't necessarily mean that they don't meet monthly, they don't meet every 2 months. So the next meeting, though, will be on Melbourne Cup Day in November. What are you thinking for that meeting?
I've been saying all year, since late last year, that it would be level all year through, and I think the first change we're going to see will be the first meeting in 2025. No change in next month, I don't believe.
Well, we'll keep a watch on that space and we will have all the fallout from the Reserve Bank meeting in our November edition of RJ Sanderson TV. Roy, you found a beauty of a chart on this next one. It's the household income, consumption and savings ratio. This tells a very interesting story. Talk us through this one.
Yeah, so your top orange line is consumption. That's what we're spending. Throughout COVID, it was quite high. The blue line is our disposable income. It's back to zero. Interestingly, we're not spending, we're break even, but the interesting one is the savings ratio. Throughout COVID, we had lots of money, which is why we were spending soon after COVID, but now we've got nothing left. So our consumption is certainly going to be flat because we've spent our savings that we got during COVID, and that has a big impact on slides we've just seen on GDP.
I think this is a fantastic chart. It ties together all of the charts that we've already spoken about, GDP, but also inflation as well, because there is no more savings to spend. So perhaps that does allow inflation to be curbed because people simply don't have any more money to spend. And I think that is shown in our inflation expectations chart because we can see here, Roy, that inflation expectations are also at their lowest point since October 2021. And perhaps that can be attributed, as you said, in part to the fact that people have no more savings left. So I think this chart combined with the previous chart absolutely marries up to your hypothesis that we will see an interest rate decrease at the start of next year. One thing that's also quite interesting is that consumer confidence, Roy, is also marginally up. Now, what I think is starting to form here is a narrative of, as your club's former coach Brendan Bolton used to say, green shoots. We're seeing some green shoots for the economy. You marry that up with business confidence, which is our next chart, that is also on the increase, and it rose almost or just over 6% there in the last month. And have a listen to this, Roy. It says this number was revised amid notable improvements in retail and recreation and personal services. So this is suggesting that things are starting to stabilise, particularly from a consumer perspective. People are not feeling like they're in the state of flux that they have felt. Things like wars overseas, elections overseas can influence that. But people feeling a level of stability that they haven't quite felt in many months, I suggest, and some green shoots starting to appear. You couple that with the stock market that is also now at record highs, and the narrative is suddenly, in the last month, quite different to the one that we've had over the previous few months.
I love that terminology, green shoots. So let's keep using that. 100% agree. Almost a 16% return in the last 12 months. Now, I did go on record late last year when you asked the question, what will the share market do for 2024? I said it will be 16 to 18%. I know we're not there yet, but we're certainly on track. And it's been quite logical in my mind that people who are looking at the share market just don't buy the Australian Stock Exchange 200. Get some advice from professional advisors as to which would be the best 10 or 20 stocks to buy, because you get the right advice on the share market and you can do even better than 16%.
Property is always on the agenda on RJ Sanderson TV, and we start with the changes in dwelling values over the last 3 months, Roy. You've got a couple of highlights and a couple of underlines on this one.
Yeah, I've underlined Western Australia, Perth. In the last 3 months, 4.7% gain in Perth, and I've highlighted on the left there Melbourne, negative 1.1. Just awful over the last 3 months in Melbourne and regional Victoria, complete opposite to what's happening in Perth. And if you take the 12-month slide, you'll actually see that over 12 months, Perth has done an amazing 24.1%, and Western Australia 19%, but Melbourne 1.4% negative, and regional Victoria 1.5% negative. So Melbourne is doing the opposite to the rest of the country, unfortunately.
How long are prices or houses staying on the market, Roy, at the moment?
They're quite a while. If we actually look at Melbourne, 12 months ago, a property was on the market for 27 days. It's now on the market for 41 days. And if you look at the differences between the grey line and the orange line, most of them are slightly above, some are slightly below, but none have changed at the same value as Melbourne. So not only are Melbourne's property prices decreasing, the properties are finding it harder to sell. They're on the market a lot longer.
Have a look at that in Perth as well, by the way, Roy. If you want a house, you've got 11 days to purchase it in Perth. That's quite extraordinary when you think about going and buying a house and the decision making that goes into that and the consideration set. 11 days to buy that one.
Imagine that. You put the house on the market today and on average it's sold 11 days later. Wow.
Listings is another indicator that we look at to get a gauge of how things are, and it looks like things are on the decrease here.
So the idea here now, this is across all of Australia, so it's not necessarily Melbourne, but we can see that we have more listings than what we had 2 years ago. That means there's more supply, which means that's pressure on prices to come down. So compared to some 2 years ago, we are quite a fair way away. Like it's about 7,000 or 8,000 homes more on the market, which is a bit of a worry.
Interesting stuff there. The other thing that is interesting to look at is the increases in rental yield and what that's doing. How's that looking, Roy?
Now, because Perth are going up in value, their rents are going up as well, and they get a 10.9% return. Their rents have gone up by 10.9% in the last 12 months, and Melbourne's have gone up by 6.5%. Now, I can tell in the market, as I'm talking to a lot of clients, a lot of real estate agents, I reckon early next year we'll talk about the rental market in Melbourne coming off the boil. So they won't be increasing at 6.5%. They will tamper off a little bit.
Talk us through Victoria and the state of play at the moment, Roy, because I know you've got some strong thoughts on that.
Yeah, the trouble we have here is that Victoria are out on their own because there are some taxes that are the highest land tax in the country, plus we've got this Victorian vacant land tax that the first assessments hit in February 2025. They affect holiday homes, they affect anything that's on short stay rentals, if it's rented for less than 6 months, and anything on Airbnb or short stay, most of them are less than 6 months. It's very hard to get rented for more than 6 months. And the capital improved value, not the land value, gets hit with a tax at 1% in the first year, then 2%, then 3%. This is an awful, awful tax. And I noticed that just in the last 48 hours, the short stay property tax of 7.5%, which is in Parliament right now to come into play on the 1st of January, the opposition have indicated they will dump that short stay property tax if they get elected.
Watch that space. And another space to watch, Roy, as you mentioned, because it is tax time for those that are playing along at home on their own, which, of course, we don't recommend, rjsanderson.com.au if you do want someone who is a professional to do your tax return. But let's get into some tax tips all the same, because it is tax time for some, and you've always got some handy tax tips, Roy.
Yes, I just thought this is a good one because if you've got more than $250,000 in super combined with your partner, you can set up a self-managed super fund and you can actually purchase a property investment. Now, you might say, why would Roy say buy a property investment when he's just said property in Melbourne and Victoria are going down? Because when you want to invest, often it's about getting into the market and doing what the herd are not doing. So buy when everybody else is selling, when prices are low. They won't stay low forever, and don't try and pick the bottom of the market. So if you can hold that property in your self-managed super fund until you retire, the capital gains tax on any gain is zero taxed, potentially. I say potentially because if you earn more than 1.7 million on that property, you may pay tax, but that will be okay if you've got a $1.7 million profit, Dave. So that's our tax tip, is buy property in a self-managed super fund, hold it till you retire, pay no tax.
The ATO and their regulation, the regulation that governs tax, can be complicated and confusing. There is a rule that I have on my rundown here. It's called the Rule of 72. I've got no idea what it is. Talk us through it.
So Rule of 72, if you get a 7.2% return, the value will double in 10 years. Conversely, if you get a 10% return, it doubles in 7.2 years. So if you purchased a property today, let's say it's in your self-managed super fund, because that's what I'm suggesting you do. In 10 years' time, if it gets a 7.2% return, it will be worth $1.4 million. That's a $700,000 profit in your super fund, and if you've retired when you sell it, you pay no tax. It's just amazing. It's the biggest tax benefit going around at the moment in Australia.
Wow, that's a big grab. The biggest tax benefit going around at the moment in Australia. Roy, for those that are watching at home that are thinking, I'm not sure whether I fit into this category or whether this is applicable to someone else, can you give us a bit of a broad brush of who the type of people are that should seek advice on this? What's the age, demographic profile that you think this would be applicable to?
It's probably never too late to invest in property or super, but if you're within the last 10 years of retirement, you're almost leaving it too late. Ideally for property, it's long term. You want to see the gains. But if you're in your mid-30s, 40s, and you're in a relationship and you've got somewhere 220,000, 250,000, then you're in a sweet spot where you should be looking at self-managed super fund in a property. That's the perfect scenario. But certainly the earlier you get wealth management advice or financial planning advice, the more money you'll make in retirement.
I just want to push this point, Roy, because I think as someone who's in that age category, it's always good to get more information. So perhaps I can say someone comes to you for tax advice, you fill out their tax return. That's quite a simple transaction that most people are aware of. What's the first step in getting wealth management advice for someone in their 30s, as an example, where, you know, for people in their 30s, it might not be front of mind. It's not something that you're thinking about, retirement, and there's potentially barriers that you feel or perceive are there that you need to jump through. What does that look like?
So one of the things we do when we do a tax return for a client, and it might be just a basic personal tax return, salary and wage earner, on the ATO portal, we check the superannuation balance for each of the partners, And if there's a conversation to be had about where they're at with super, whether they should contribute more to get tax deductions, where their life cycle is, are they saving for a home, are they saving for a car or a holiday, what should they be doing with their disposable income to get the best outcome from a tax perspective? And that's the conversation we have with our clients, because that's doing the tax returns actually the easy part. That's absolutely the easy part. We'll maximise the refund. It's about thinking outside the box. That's the more crucial thing that you want from your accountant.
Talking about thinking outside the box, I think this viewer is definitely thinking outside the box with this leading question, Roy. It says, can I claim kilometres to visit the accountant to have my tax return completed? What if I live interstate? Does this apply to the airfare and accommodation?
Well, here we go. We have some good news. The answer is yes.
Wow.
You claim kilometres to drive from home to the accountant and back home again. And if you're local, that's fine. If it's only 10 or 20 kilometres, we still put it down. But if you do live interstate and you have to fly or drive and have accommodation to visit the accountant, yes, that's also tax deductible. But it must be the purpose of the trip. It can't be I'm going to a wedding and I'll catch up with Roy or the RJS team while I'm down in Melbourne. It needs to be the purpose is to see the accountant, have my tax return or my accounts or my business or my self-managed super fund completed or signed off. It's got to be purpose of trip. And so the answer is yes, you get to claim them, Dave.
Roy, have you got an office in Port Douglas?
We don't. We have Brisbane. We've got Corowa. Maybe we should be looking at France.
Yeah, I think so. Anywhere where we can, as you said, for the purpose of doing our tax return. You know, you want to do it in a nice location that's relaxing, maybe a beachside accommodation, some nice weather. That'd be fantastic. But let's put all the niceties on hold for this segment. It's called Roy's Rage, and Roy, like most weeks, I think you're moving into the property space. What have you got for us this time?
Yes, well, this sort of gets me a little angry because we've had politicians go public, and I know we're not right on the verge of an election, and they've said they want to cease negative gearing. And I know this is independents, Greens, etc. Now, negative gearing, if they say that they want to get rid of negative gearing, they should not be in politics because the bar is too low on their education, their background. We know we have a housing crisis. Now, negative gearing was invented in 1936 to solve a housing crisis. Why would we get rid of it now that we're in one? Hawke and Keating attempted to get rid of negative gearing in July 85. It was a disaster. Just over 2 years later, it came back in September 1987 because house prices had plummeted. So I just say that if our politicians, if their level of intelligence is this low that they're saying get rid of negative gearing, then I challenge them. They should not be in government. I would not vote for anybody who is suggesting you get rid of negative gearing. It's a disgrace.
Whew. Off the long run, as always. Roy, put you on the spot here. What about capital gains tax? Is that something that should be looked at or revised or considered?
I think the current rules aren't broken, so I wouldn't tinker with capital gains tax. You pay tax on half the gain. There's got to be incentive to buy housing or buy shares. So I like the way capital gains tax is positioned right at the moment. Not broken, don't fix it.
There you go. We are just about finished on RJ Sanderson TV today, but we always love a shout out at the end of the show. We kick off with Grumpy Gary's. Talk us through this one, Roy.
If you like hot sauces or really nice flavours, go to Grumpy Gary's website and put in the code OCT10 and you'll get a 10% discount off everything on the store. And I've got to tell you, my family, big fan of these products, absolutely love them. They come out every Sunday family dinner. I guarantee you they are wonderful.
Not one, but two shout outs this time. We've also got 10 Minutes by Tractor.
10 Minutes by Tractor. They're a two-hat restaurant down on the Mornington Peninsula, awarded Best Winery. I've been there fairly recently and they are sensational. It's a destination place. You want to make an effort, get down to 10 Minutes by Tractor. Not only is the wine sensational, but the restaurant is top-notch, rated very highly around the world.
Love the name as well. It's a cracking name. And it's been a punchy show today, Roy. I think we've made good inroads. Have you got a November prediction for our last show of the year?
I don't know who will win the Melbourne Cup, but somebody will. Economically wise, I don't think interest rates will change on the Melbourne Cup day. I think they'll stay the same. It's very interesting that 12 months ago I said they won't change all this year. Every major bank said that we'll have decreases this year. They've all changed throughout the year. They've copied us, so they should watch this show.
Jan Bruegel, an undefeated horse in the Melbourne Cup that'll go round as the favourite, Roy. We've never had an English St Ledger winner in the Melbourne Cup, and it's the first time that an unbeaten horse has run in the Melbourne Cup since 1883. So some big stats around the favourite in the Melbourne Cup. Gamble responsibly if you are having a bet, but that is an extreme form line for the Aidan O'Brien trained horse. Thanks for joining us on RJ Sanderson TV today. Hope you've enjoyed it and hope you learned something. We'll see you in November.